Stack Hartsock, ACI Wealth Advisors, welcoming you to the most recent edition of the Bull and Bear Report, the July 2019 Market Risk Update. In the interest of your valuable time, I'm going to get right into this. I am the market strategist for ACI, and the risk update is part of the independent research that we do that's a little bit different from what almost every other firm out there does. Specifically, in addition to trying to grow your funds and your assets during times where the market is stable, we are also very interested in protecting those assets during times when the market becomes less stable, when the investment climate is less predictable and more difficult. A little bit different than most firms. If you'd like to learn more, just visit aciwealth.com or get in touch. Okay, real quick, talk about the ACI 13-point risk management model. Some of you may be familiar with this, might be new to some of you. For some of you, just a very quick refresher. We have basically three different things we look at in the risk management model. We have a tactical component, we have a fundamental component, and we have a macro component. And I'm going to briefly kind of skate through each one of those and talk about what things look like at this point. The first one of those is the tactical component. Now, real quick, the tactical component is the least important part of the risk model. Nonetheless, it is fairly important, as I'll show you. But what the tactical model's role is really to be the canary in the coal mine, to give us an idea when it's especially important for us to pay attention to the fundamental and macro aspects of the risk model. And the reason for that is the tactical model can be wrong. It's given a couple of false signals in the past, and you have to wait for the macro and the fundamental models to confirm what the tactical model is telling you before you make serious adjustments in your portfolio or your risk. So let me just outline how this works very quickly. The red lines coming down here where you see my mouse pointer are areas or times where the technical model, sorry about that, where the technical model has issued a warning. And the way it works is this is price down here, these little green and red bars. And then there's a yellow line here and then a blue line right there, right below it. And so what happens is the first element of the tactical model or technical model is when the blue line falls below the yellow line, because that means the short-term trend of the price of the market is falling below the long-term trend. But that's not enough to set off a warning. The next thing we need to do is look at what's called relative strength. And what we see is, in order to generate a warning, the relative strength has to be falling off of what's called an overbought condition. That's where you see these little green tips here and here in the middle of your screen and over here and here. In order to be valid, we have to be coming off that overbought condition. Otherwise, it's just a false signal and kind of noise in the market. Now, the next element of it is what we call moving average convergence and divergence. And the way that works is sort of similar to the moving averages up here. We're looking for the blue line, which is the shorter term, to fall below the yellow line. And this is a little bit different than the one up top. There's more calculations involved in this. But what we see is that when all three of these things happen at once, right? So the relative strength is falling off an overbought condition. The short-term trend falls below the long-term trend in price. And then we see the short-term moving average falling below the longer-term moving average on the moving average convergence and divergence. Then what we see is generally that results in a situation that's not necessarily great for investors, but not always. So we can see that because we got a warning back before .com, and then things went down 36% between the time we got the warning and the time we got the all clear, which is the green line. And then we get the green line and up we go. Now, if you had just used this element of our risk management model, right, which is the least important element, and you had have completely liquidated when we got the red signal, you know, the red line, and completely bought back in when we got the buy signal or the green line, and I'm not recommending you do this, this is just for an illustration, you would have doubled the performance of the S&P over this time period. So this is a very useful canary in the coal mine indicator. So let's move on. Last fall, some of you may recall the technical model issued a warning. And so we looked very hard at the fundamental aspects of what was happening and the macro aspects of what was happening, and determined that this was going to be a short-term phenomena, and that rather than looking for opportunities to risk down, it was an opportunity to look for things to buy, right? So any dip that happened in the market, any serious correction, was going to be an opportunity to buy. And As time moved forward, what we discovered is that turned out to be right. We went down 16, 17% between the time where we got the higher risk signal and the time where it went away earlier this spring. And since the signal went away, we're up, a little over 7% right now, and the market's moved on to new highs. What's interesting is we may also be setting up for down here in terms of the convergence divergence of a new bullish signal here as well. So that would be pretty interesting. Don't want to read too much into it, but that's something we haven't seen in a couple of years, and so it'll be fun to see how that plays out. Moving on, let's talk a little bit about the fundamental model. Serious bear markets occur during recession, and knowing that, we set out to identify a way to understand when the U.S. was in recession. And I want to qualify this by saying this is not predicting recession. We're not in the business of predicting recession. Those of you that watch this know what I'm going to say next, and that is no one in the history of mankind has ever been able to consistently predict the future. And there are tons and tons of people that have all kinds of credentials that are on TV all the time. And the funny thing is they're always predicting recession, and they're never right. Or if they are right, they're right once in their life. So we're not in the business of predicting recession. What we are trying to do, and what can be done with essentially 100% accuracy, is understanding when the U.S. is in recession. That's what the recession probability indicator, or RPI, does. And so what we've done is identified some data sets that the Federal Reserve publishes, so anybody can go find them. There's hundreds and hundreds out there, and we had to look through them all to figure out the ones that identify when the U.S. is in recession with 100% consistency since the data has been available, and that's all the way back about 60 years, 50 years, 60 years, and then built a simple algorithm that would give us a very clear and simple signal to understand when the U.S. had actually moved into recession. And essentially the way it works is when this algorithm moves above 20, it gives a warning that we're in recession. If it stays above 20 for 2 months in a row, then that confirms the U.S. has moved into recession and the investment climate is no longer stable. And so if we look at where we are right now, and there's about a 2-month lag on this, it's just kind of banging around between about 12 and 17. It's been doing that for a couple of years. In general, it moves between about 2 and 17. So whenever it's in that range, despite what the media says, despite all the fear mongering that can occur, and the pundits with all their opinions and the analysts and everything else, things are by and large pretty good. And that's the situation where we find ourselves in now. The economy is growing. It's not going gangbusters, but it's growing. Earnings so far, we'll see, are growing. Some of the other factors that are important in the economy are also relatively stable. And so at this point, the U.S. is not in recession, and therefore investors are much more likely to be rewarded for continued investment than they are to be punished. Now, let's look at the macro aspect. So this is a question about what drives bull and bear markets, right? There's really 4 primary factors that are macro factors, and that's earnings, inflation, interest rates, and whether or not prices are moving up or down. And some of you may be confused because I've highlighted 2 sections here. If you recall the last couple updates, we were right here in a case 4. This is based on Toledo's work. Case 4 bull market, where earnings were rising, inflation was rising, although weakly. Interest rates were up. Again, this is prior to today. And prices were also moving up. And that's what's called a bull market end phase cycle. Now, that sounds scarier than it is. Bull market end phases can last for years and years and years. So you don't want to get out of the market just because you're in an end phase cycle, because then you and your family can miss out on the enormous benefits that a bull market confers upon investors, even if it's in a late stage cycle or a later stage of the cycle. Now, what's happening now is something that's pretty interesting. Is we're seeing that inflation is actually weakening a little bit over the last couple of months. And as a result of that, and now I'm looking at case 2, as a result of that, we now have a Federal Reserve that has stopped hiking rates, and actually interest rates have fallen fair amount over the last couple of months. And there's the potential they're going to fall further because Chairman Powell has kind of opened the door to cutting rates if anything gets a little scary out there in the big bad world. So if the trade deal for China begins to impact the economy in a truly negative way, basically Chairman Powell is going to cut rates. if the economy begins to fail internally for any significant reason, or if it doesn't appear that whatever is causing the economy to slow down is going to be transient, he's going to cut rates. So if that's the way it actually plays out, then we could be in a situation where earnings are growing, and they should grow in quarter two. Not going to grow much, but they should grow in quarter two. Inflation is flat and maybe even down a little bit. Interest rates may fall, and yet prices are up. We just hit a new high a day or two ago. Now we're in a situation where the bull market thrives. Pardon me. And that's kind of very unusual, to go from the end phase of a bull cycle into a part of the cycle where the bull market thrives. So in order to figure this out, we're going to have to see what happens, if rates are cut, or if he begins to stop the roll off of the balance sheet. And also, hopefully earnings will continue to grow a little bit, as I anticipate. And if so, then we may find ourselves in a case two bull market, which would be very interesting. And it might be temporary that we're there, but if we do move into that, then that definitely sets the table for the market to potentially move on to higher highs than we've yet seen. So I want to move on here, talk about something else. And this is the one most powerful factor there is for determining the direction of the economy and potentially the direction of the stock market. And that is the real Fed funds rate. What that means, for those of you that don't know, is the federal interest rate, the Fed's control interest rates. And you take that and you subtract inflation, and that's what's called the real Fed funds rate. And what we can see here historically, and this is all the data I could fit on the screen, but we have never had a recession when the Fed funds rate, the real Fed funds rate, was less than 1.6%. And sorry, that's my cell phone going off with alerts. And so if you look at this table, what we see here is these gray lines are recessions, right? So the lowest the real Fed funds rate has ever been ahead of a recession is 1.6%. If we move over here to the right side, what we see is the current real Fed funds rate is about 0.25%. So in order to create a situation which has historically ushered in a recession, the Fed would have to have the real Fed funds rate 5 times, 6 times higher than it currently is. And the kind of insider's joke, as in professional investor, professional advisor joke, is that bull markets don't die of old age, right? That's a media myth. Bull markets are murdered by the Fed, and they do that by raising rates too aggressively. That causes the economy to begin to slow down and ultimately move into recession. I don't think Chairman Powell is going to let that happen without a fight, because he is on record repeatedly as saying he is in here to continue the expansion. And I think that's what's going to happen. I think if we get any major risk coming out of a potential trade war, which looks more likely at this point, then he's going to cut rates. If we have something else that happens that really represents a big risk to the U.S. economy, I think he's going to cut rates. And if that happens, then we're going to move from what is essentially a neutral rate into something that stimulates the economy. In other words, helps it grow. As the economy grows, the market has a tendency to rise. And here's the demonstration of that phenomenon. Below here we have what's called the Wilshire 5000. So a lot of different ways of looking at the stock market. The Wilshire 5000 is more inclusive than the Dow Jones or the S&P. The Dow Jones is 30 companies, S&P is 500. The Wilshire 5000, pardon me, is 5,000 companies. So it's a better reflection of the impact that interest rate policy can have on the market and the economy. And you can clearly see that when interest rates get too high, right, when they get up above this 1.6 rate and higher, that has a tendency to crash the economy, and the market also has a tendency to move down when that happens, right? And you can see that right there. As we move into recession, rates get too high, the market falls. Well, that's not the situation we're in right now. So you can shut this off if you're not interested in my opinion as to what happens next. If you just wanted the risk update, which is all the data that really drives us, I'm kind of like the Fed, I'm data driven. I can offer an opinion as to what I think is going to happen next. It's certainly not a forecast, and my opinion is subject to any change in data, right? So the data changes, my opinion changes. Right now, based on current data, what I think is going to happen is, if we look at this kind of top section here where the mouse is I think the market is going to pull back a little bit from here, maybe bounce around in this section a little bit more for, a little while, and then I think it's going to probably move back up, assuming that we don't find ourselves in a situation where corporate earnings begin to fail. right? So if they grow, that's really all that matters. It doesn't matter if they're just growing a little bit or if they're growing a lot. What matters is that they're growing. And currently it looks like Q2 earnings are going to grow a little bit from prior earnings. Now, just to let you know, there's a lot of talk about how grossly the market is overvalued right now. Well, the blue line right here is what's called fair value for the S&P, right? And so we're really not that much higher than fair value at this point, and the market has a tendency to price in the future, right? So fair value, assuming there's absolutely no more earnings, the rest of 2019 is right here. If we factor in what the earnings are likely to be throughout the rest of 2019, then we may be just a little bit above fair value, current fair value, somewhere in this 2950, 3000 range. But we'll see how it plays out. So that's what I think is going to happen, for what that's worth. I think the market is probably going to bang around in here a little bit. I think we're going to get something that's going to cause a pullback. May come down, to say 2800, this red line here, which is the current intermediate uptrend, may even come all the way back down to fair value if there's a big scare or thereabouts. But what's going to happen is, as long as there's no change in earnings, as long as earnings continue to grow, as long as interest rates remain low, the table is set for the market to hold steady and potentially move up again before the end of the year, so we close even higher than we are now. So that's my opinion. We'll see if it changes at the next risk update as the data changes. Other than that, if you have questions or you have a different opinion that you'd like to share, I'd welcome it. I'm always open to the idea that I might not understand something, but in the meantime, you know where to get me. Partners all have my contact information. If you're not a partner with the firm, then you can just go to the website. There's a contact page, and I'm happy to answer your questions or respond to any kind of inquiry. So thanks very much, and hope everyone's enjoying the summer. We'll see what comes next.